Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Monday morning. All right, so a couple things to kick off today's discussion. So first of all, I do want to mention, and I realize the notes are a little bit covered there, but hang on, let me fix that. One of the things that I want to make sure that we remember is two things. One, consumer-related data, right? We had the retail sales reaction this morning, and if any of the economic data reflects that the consumer is generally not buying stuff, right? This could be home sales, this could be existing home sales, obviously any kind of consumer sentiment numbers, or as in the case of today, we had the retail data. Bring everyone over there. All right, let's see. Retail data. Today we had core retail sales, and you'll see that retail sales was a miss. Not only is the current number a miss, the previous was revised lower. So this shows that there was less consumer retail activity at the core retail and retail sales level. By the way, anytime core, the word core is in front of whatever the data is, that simply means they omitted something, that something is not included. In this case, with core retail, they exclude auto sales. But nonetheless, these were misses. So why are we seeing this pretty sharp move higher in the NASDAQ as a reaction to a quote unquote miss? Because that continues to put pressure on the Federal Reserve to cut rates. All right, so let's measure that directly. The way we measure that directly is we head on over to the CME FedWatch tool. And what that does is it gives us a look at the Fed Fund futures data. So imagine like gold, like crude oil, like the S&P, there's a futures contract dedicated to the Fed funds. And all they're designed to do is speculate on, instead of gold or instead of crude oil or instead of the S&P, they're speculating on what the Federal Reserve is most likely to do at the next meeting. There is a meeting on Wednesday. It is not in any way on the table for rate cuts. The Federal Reserve is under no pressure to do so. So you might say, well, Rog, how do you know that? I'm going to look at the data, right? And if it shows 99% chance of a hold, we're currently at 4.25% to 4.5%. You'll see the 4.25% to 4.5% column is at 99%. The Federal Reserve says, look, they don't expect it. We don't have to do it, and they won't. All right. If let's say they cut, so surprise cuts aren't as great as sometimes they're cracked up to be, because the stock market is a tantruming 3-year-old. And what that means is, let's say the Federal Reserve were to cut on Wednesday. Sure, initially the equity markets would rally because stonks love cheap money. However, then the next wave of sentiment becomes, oh, what are they so worried about? What do they know that they're not telling us? What's the problem with this type of cut when we weren't expecting it? So chances are they won't. We move out to May, and it becomes a little bit more probability that there could be a cut. It's barely 24%. The conversation is happening for June. Yes, June is discounted mostly for a cut. So every press conference that accompanies the Federal Reserve meetings, the 19th of this month, the 7th of May, is not really about whether or not they cut or not. It's really about what is the press conference? What is the messaging like? Does Powell remain open to accommodation? He better, right? Because if he's not, he's doing that on purpose. So this goes to, how do we read Fed Fund futures? So one, they could change this, meaning Powell specifically, but any of the members speaking could change this with messaging, with their words. They could realign expectation, push the Fed Fund futures expectations further out into the year, or bring them closer, which is less likely. If they don't agree with what's being seen here, and believe me, they know what this looks like. If they don't agree with it, then they're going to talk it up or down. And that's why the press conferences and, frankly, the rate statements are going to be so important. Gang, that is a easy breakdown of macro. Does the core retail sales number mean macro? It does, but it's only a stepping stone to this, right? It's only a stepping stone to understanding what the Federal Reserve is going to do next. Gang, the only macro that matters is monetary policy. So we look at certain kinds of data to give us insight into what the Federal Reserve may be thinking, and then it plays out here. So all we need to do is go take a look at this data and say, hey, did that data change expectations for March? Did it change expectations for May, etc.? So take a look at this. If you're looking for this link, just Google CME FedWatch, and it will come up with this link. So that's where we are post retail sales. You can see that we shot right up. We've taken about half that move back. A couple other things to note about this morning. We are trading over 1% above the previous session close. So one of the things you might have seen, maybe yes, maybe no, was on Friday, I cut a video about how to buy puts in a down market, right? This is not a bearish environment. If prices were to sell off past, say, 20%, we're barely at 10 right now. We're just below 10, right? We get to 20 and stay there, we can start talking about a bear market. It's way too soon to be talking about bear markets. We had a dramatic pullback. Yes, the daily time frame is in a very new, very fresh, and frankly vulnerable downtrend. All downtrends are vulnerable, especially when the backdrop of the narrative of a downtrend is that the Federal Reserve is still open to cutting 2-3 more quarter point cuts. All right. So then the next thing we got to remember, here we go, is taking a peek at, there was a question about bonds. Sure. So we're not in a bear market. We're not below 20%. And what that means is the longer term weekly still presents a lot of opportunities for traders who are trading with more of a position trade mindset, with a mindset of months to years, not a mindset of days to weeks. Days to weeks is a very different psychology. So be careful when folks start, especially fear mongering, about the bear market. This is not a bear market. This is a dramatic pullback. And yes, it's broken the uptrend. Yes, in some situations we're in downtrends, but take a look at that weekly and take a look at where we are in relation to a 10% pullback from all-time highs and a 20% pullback from all-time highs. This is not as scary as the folks who want you to tune into their television stations would really want you to think. Okay, next is bonds. Are bonds in an uptrend? No, but they're not in a downtrend either. So where are we in relation to the pullback on bonds? We barely got to just in front of a 10% pullback from the all-time, from the highs, as you can see here in the center chart on bonds. The thing that I'm going to look at to assess whether or not they're in a downtrend is to look at, I'll show you right now, this lower section right here of my chart. This is the multi-structure. And you'll notice that we were green. That was the uptrend, right? Especially this lower row. The lower row is the trend. The upper row is momentum. Notice that it's gray now. That means we have a neutral momentum. We have a neutral trend, but we have a saying in the Sector Secrets Mastery: respect the trend that was. So if the trend that was, in this case, an uptrend, transitions into a neutral market. So it changed its behavior. It's no longer in an uptrend, but this makes it bullish chop. This makes it still prime for long setups. All right. So Jay, yeah, this is still a bullish environment, but it's no longer an uptrend. And what that's going to do is shift the type of strategy. So you might say, okay, Rob, cool. I get that it's no longer in an uptrend, but what's the strategy that I would use? So everyone in this room should have a strategy for trends and for chop and for sideways narrow ranges. So trends, chop, channel. Every single one of those behaviors is different than the other, requires a different type of strategy to take advantage of the moves. So in this case, let's talk specifically to chop, since that's what's happening here on the daily time frame of the bond futures, which translates, by the way, to TLT. What do we do with this? Well, what are the tools you have in your toolkit that help you understand overbought and oversold? Right? That's not a conversation for trends. When I hear folks talk about overbought and oversold in a trend, what I think is that's just a basic misunderstanding of what a trend is. A trend is an imbalance. A trend is an imbalance of what? More buying interest than selling interest, more support than resistance. And if you look at it that way, there's really no such thing as overbought or oversold. And an uptrend is sort of in a perpetual state of overbought, right? If you ask an indicator whose only lens to the market is it too high or too low? Is it overbought or is it oversold? So it's the wrong tool for the job. Kind of like pulling out your putter when you're at the tee, right? Great club, wrong shot. Now I can step back and say, all right, Rag, I've got a couple tools in my toolkit. Maybe you're using a slow stochastic. We have a number of things we can use. I use something called the secret squiggle. It's just an overbought, oversold tool. Whatever that is for you, put that on your chart in a non-trending environment and focus on the long side. Focus on where we sink down to oversold. Focus on where we sink down to support, right? And then that's where we would look to set up the long call or the long futures trade or whatever it is. And that's the way that I'll look at that the way in which the structure changes very naturally in any environment. It happens on 5-minute charts, 1-hour charts, daily charts, weekly charts, what have you. So that's really what we're looking at here right now. So this is not just about bonds, but this is also about, hey, Rag, I may not have a set of tools that I love for non-trending markets. Have a non-trending set of tools and have a way, even more importantly, what's upstream of this conversation, that there is in fact a methodology or an indicator that you use to differentiate trends from non-trends. The multi-structure is a real-time tool that with every single candle, it doesn't matter if it's a 1-minute candle or a weekly candle, every single candle, there's a reassessment. Is the momentum still bullish or bearish or neutral? Is the trend still bullish, bearish, or neutral? So that's what I mean about when I say real time. This isn't about waiting for a series of moving averages to cross. That's way too laggy. Every single candle, we should be able to have a very clear read on bullish momentum, bullish trend, etc. Right? And you can see here, we lost the bullish trend, we lost the bullish momentum. All right, so let's see here. And again, for those of you that are wondering, how has this idea of a bear market versus a downtrend, let's talk about that for a moment. This idea of a bear market versus a downtrend. They are not the same thing, right? And so again, I'm sure there's a myriad of ways that traders look at why they would call whatever chart they're looking at a bear market. So first of all, a bear market is a larger assessment, typically on longer term timeframes. And for me, I'm going to use, and by the way, I truly, in the way that I'm breaking this down to you, view a bear market as something that financial media has created, right? They've created this word called bear market because they need something to label the behavior as. And frankly, it's kind of easy to understand, and especially if it's a bear market, it's kind of easy to get people frothed up, nervous, and keep them tuned in. Please remember, gang, most financial content is entertainment, right? I hope I'm a little bit entertaining. There's nothing wrong with that. But what we want to remember is at some point, there needs to be some instruction. There needs to be some definition. So when I define what's a quote unquote bear market, it's going to be a prolonged period of time. I don't mean a couple of days. I'm talking weeks. It's going to be a prolonged period of time, usually at or below around 20%. 10%, that's a pullback. That's a retracement. You could use the word correction if you'd like, right? So when I look at that larger label, which is really just, again, something that I largely perceive as something created by financial media and financial entertainment to label something, to grab attention, to simplify it, sometimes to almost a useless degree. You'll never hear me talk about this a bear market unless I'm usually using the wrong word for a downtrend. Let's talk in terms of structure, and nothing about the structure on the weekly or the daily time frame for me is in bear market territory, if you will. Where we are, let's move that daily and weekly into view. Where we are in pretty significant pullbacks. And if we linger in the 20% pullback for a little bit longer, then yeah, that sentiment could set in. So that means that I've got to get, number one, at least to about 5,000 on the ES futures. Notice we're bouncing from about 5,500. We barely made a 10% pullback. That is correction, right? That's not bear market territory. And again, I'm going to assess that from the all-time high. The uptrend on the weekly is barely broken down from its all-time high uptrend. So yeah, while it's bearish, it's not in bearish territory. While the daily is still above the 10%, it is in a downtrend. And it might sound like, oh my gosh, Rog, what do I do? Really easy. What is your time horizon? This is the easiest way to cut through all the noise. What is your time horizon? Rog, what does that mean? When you put a trade on, and when I'm putting a trade on, I'm thinking about how long the life cycle of that trade could be. That's the time horizon. How long could I be in it? And on a daily time frame, that's going to be days to weeks. So being in bearish territory, being in a bear market, that's all sort of noise, because frankly, compared to say a weekly, this is a pretty short-term view. I'm looking at one candle per session as opposed to one candle per week on the weekly. So it's a little bit more nimble. And here we can see, as of specifically, right, real-time assessment, as of the 13th of March, this is in a downtrend. Now, those of you that have been following me in Charts and Coffee, or those of you that are in the Sector Secrets Mastery, know that we love trends, we love uptrends. Downtrends, especially in a macroeconomic environment. What's macroeconomic? Looking at jobs, looking at inflation, that's mainly it, and looking at growth. So those are the three metrics of macroeconomics. So I'm looking at jobs, I'm looking at inflation, I'm looking at growth. In that environment, the Federal Reserve is still very accommodative. They're still very much open to cutting rates. Does anyone here think that's bearish? The reason that they might cut rates, for example, the rate cuts in Q1 of 2019, the rate cuts in Q1 of 2020. Yes, the catalyst was in many ways a panic. But what was the result, right? What was the result? Well, the ensuing price action in both situations were some of the most rapid uptrends in the history of humans, right? So remember, the reason for the cuts may not be great, but the output after a series of cuts is usually bullish to equities. This is not the time to be big picture bearish, which is why for the past couple of weeks, actually probably 2 or 3 weeks now, I've been talking about, look, yes, it's very volatile. Yes, we are operating sometimes outside of the 68% probability of price movement. What usually happens 2/3 of the time, we're going beyond that. That's why this environment feels so crazy. It's not the trend. It's the way in which the highs and lows are just so dramatic every session, most often. Now, if I were to lengthen out my time frame and say, Rog, 12 months from now, am I going to regret? This is what I ask myself, right? 12 months from now, am I going to regret not creating a shopping list? 12 months from now, am I going to start asking myself, should I have looked at some of my dog is upset at, oh, the pool guy must be here. Am I going to be kicking myself for not looking at Amazon at 190, at 200? Give me 1 second here. The dog is really upset about this long-term conversation, clearly. Okay, so let's finish that thought. I corralled my dog. All right, so keep in mind, if you're not looking at the weekly right now, I'm not saying you need to buy today, and please don't buy this higher, but we're going into the end of quarter, right? We're going into the end of quarter. There's going to be a lot of decisions made. So let me ask you this. Imagine for a moment you're managing tens of millions, if not hundreds of millions of dollars, and your job is to show positive results, a return by the end of the year. Are you looking at this fearfully, or are you looking at this opportunistically? And my my opinion, my tact is I'm going to look at this opportunistically. All right. So thank you so much for being here for Charts and Coffee. My puppy thanks you too. All right, gang. Be good to each other. I'll see you tomorrow, same time, same station.